So hello everyone, and I again hope everyone is well. So I'm making part 4 now of the chapter 6 um, finance on government interest bonds, corporate bonds, and interest rates. Okay, so there's as I said, as we left off, there's many legal aspects of corporate bonds here, and bonds could be either secured, unsecured. So if they're secured, they're backed by some form of collateral, right? Assets, possibly, right? So as we said here, you have a claim on the assets, kind of like the people in Enron did, right? Okay, so there's always a trustee involved, and trustees are intermediary parties. So they're a paid individual, corporation, or commercial bank, and they act as the third party to a bond indenture and can take specified actions on behalf of the bondholders if the terms of the indenture are violated. Okay, so they're kind of like they're a go-between between the bank and the bondholder. I mean, between the corporation and the bondholder. It's a little early, so I'm trying to get my words out here. All right, so there's a lot of things with regard to bonds that are important. The cost of bonds to the issuer, right? Bonds have to have a investment bank help them distribute the bonds, right? And the longer the bond goes out time-wise, if it's a 30-year bond or 20-year bond, whatever, or shorter, that's going to impact the interest rates. Obviously, the longer the term of the bond, the higher the interest rates. All right, and also the size of the offering comes into play, right? So the administrative and flotation cost by the investment bank will basically decrease. It's kind of like the more you buy of something, the better price they give you. So the prices are going to decrease that the investment bank is going to charge. Basically, as the offering size gets larger. However, there are times when the risk for the bondholders can go up, simply because if you issue too much debt, there's a greater risk of default, and you could turn around one day and be a holder of junk bonds. Okay, so you don't want the company to issue too many bonds, which in the indenture, they're going to say, we don't want you to issue too many bonds after you bought your offering. And here is the thing we talked about with junk bonds, right? So there's a lot of default risk that's possible from some companies that are in trouble, and they got to pay you a premium in interest rates. Okay, so basically, the cost of the bond. How do you start determining the bond's coupon rate that they're going to pay you when you buy the bond? I mean, obviously you want to know, right? You want to know how much you're going to get on that bond. And basically it's the current cost of money in the capital market. It starts out as the basis, but the risk also, then there's a risk premium that's added on to that cost depending on the quality of the company. So the coupon rate is made up of a lot of different things, but basically it starts out with the real rate of interest in the economy and the inflation rate, and then they'll add a bunch of other things to that and determine how much they're going to pay you. Okay, so some bonds. So there's some features that are important. Like I said, a bond could have a conversion feature. Now, depending on the bond you're buying, you got to be careful. They may give you the option to convert that bond into shares of common stock. If they do that, you're probably going to get a lower interest coupon rate on the bond because you got something that's got value here, right? The ability to convert that to common stock. So that's going to be something that you got to make sure when you look in the indenture, make sure it's not. If you don't want that, make sure it's not convertible. The other thing is you got to make sure the bond can't be called early. If interest rates go down, the bond will call it and basically issue new debt at a lower interest rate. So you got to make sure that bond isn't callable. Okay? And then the other thing you got to worry about is if they do call it, you got to know how much, and how much they're going to call it back. Sometimes they give you a little perk when they call that bond back. So here's the call premium. And again, that's the amount by which a bond's call price exceeds its par value. Okay? And sometimes bonds will have warrants associated with them. And these are instruments that give the holders the right to purchase a certain number of shares of the issuer's common stock. Right? So sometimes there may be warrants associated with them. Okay, so here's the three important yields we got to worry about with regard to bonds. Current yield, yield to maturity, and yield to call. Okay, so current yield is basically the coupon rate divided by the current price, right? So you take the annual coupon interest payments and divide it by its current price, and this is the yield including all the coupons you're going to get, plus the money back on the bond when it matures. You get your $1,000 back, and this is going to be the yield if they call it at a certain period. A lot of times it'll tell you there's certain periods when they can call the bond back, and that's written in the indenture. Okay, so bonds have a price. I mean, right? You got to pay something for the bond. So bonds are purchased and held by institutions, right? Institutions, banks, insurance companies, mutual funds, and they're also held by you. So anyway, bond prices. If you need to buy one, you'd have to call a broker, right? You would call a broker, and you would basically buy the bond. You don't buy it directly from the company, right? You would, call a bank, or if they have it, or some kind of online broker, or Merrill, like a Merrill Lynch or something. So here's some interest on selected types of bonds, right? Here's some companies, and here's the interest they pay on an annual basis. It's called the coupon rate or the interest rate. Here's when you get your $1,000 back, okay? And here's the current price of the bond. Now here's the yield, the current yield, or the yield to maturity, I should say, the yield to maturity. All right, now notice if the yield to maturity goes up above the coupon, the price of the bond goes below par. This is an extremely important concept. If the yield to maturity is less than the coupon rate, the bond's at a premium and it's above par or above 1,000. Now you notice they price it in, they move a decimal place over. So what you have to be careful about, this is really 919.80, and this is 1,019.80. But they just, historically when they print it, they show it with the decimal point over. It represents 91.98% of the par value of $1,000. So all these prices are different. So here's the price. Here's the yield to maturity of a bond, and it's higher than the coupon for Marathon. Thus, the interest rate went up, so the price goes down. You always got to know that there's an inverse relationship, right, between the price and yield of a bond. If the interest rates go up, the price goes down. And if the interest rates go down, the price goes up. Okay? So if you have any questions on that, let me know. All right, so bonds have ratings, right? And as I said, if they're rated AAA, and here's the companies that rate them, then they don't have to pay as much coupon. However, if it's a junk bond or a high yield bond, and they're close to default, you're going to have to get a higher risk, a higher return based on that risk. So they look at the financial ratios we talked about and look at that kind of stuff to determine the bond ratings. So here's some bond ratings, right? Here's some bond ratings that we have to, you can see, like this is from Moody's and Standard & Poor's. So here's junk, if you can see, right? Junk, lowest grade. So this is kind of like the junk ratings here. Everyone see that? All right, so here's all different types of bonds. And again, here's the junk bonds. Here's zero coupon bonds. Zero coupon bonds don't pay any coupons. Okay, and normal bonds are called debentures, right? Right. So there's a whole slew of different types of bonds. And here's the characteristics of each of those types of bonds. So there's a whole bunch of tables here that shows you the characteristics of all these types of bonds. And it goes on and on. So it's important. There's a good description for each type, okay? So, just kind of be aware of those. You don't have to know those exactly. Right? Here's a puttable bond. That's a bond that you can put back instead of the company calling it. Basically, you're calling it back, right? You have the option at a specific date to send that bond back to them. So it's puttable. All right, so I'll be making the next part.